Hi, my name is David Walston. I'm a CPA, and I wanted to talk to you today about infinite banking and what that means, and comparing that to just setting up a traditional investment account and what you can do with that. So a lot of times I'll get information from clients. They'll send me videos or blog posts or whatever and say, hey, what do you think of this? And half the time, or 90% of the time, there's a small bit of truth, and the rest of it's kind of just made up crap. So I've had a lot more clients talk to me about infinite banking, and so I figured I'd create a video to talk about it real quick. So the basics are, you get a whole life policy, pay premium into the policy's cash value grows, and you're able to take a loan against the cash value of the investment to use to fund things you're doing in your business to make more money. And so you still get the cash value of the life insurance policy and the death benefit, and you get to be able to use this loan that you are essentially loaning to yourself tax-free. And that in theory seems like a pretty good idea, but from a growth standpoint, I don't think the numbers work out. So let's take a look at some graphs put together real quick to kind of compare the two, infinite banking and just a traditional investment account. So, all right. So this is just for the first 20 years. You can see here that yellow line and green line are the investment account with a loan, because you can get a loan against a traditional investment account. It's just a line of credit. It's usually 80% of the value. And then you get about 90% of your cash value in insurance. And as you can see, cash value of insurance is the blue line. Red line is your loan. Yellow is investment account and loan. So as you can see right now, it's just for the first 20 years, your investment account value is way beating your cash value, and your loan you can get on that investment account is way higher than the loan you could get on your cash value. So why is that the case? Well, and I just put some numbers together for just after the first 10 years and 20 years. So your cash value is about 130. So this is based on someone who's about 30 years old, $1 million policy, whole life policy, versus an investment account. And instead of paying the premiums on a whole life policy, you just take that premium and you invest it into an investment account. So this is what the numbers look like at the end of 10 years. $130,000 cash value with a loan of about 117, with death benefit of $1 million, investment account of 215, with a loan of about 172. So after 10 years, your investment account has a much higher balance, and you can do a higher loan on it versus your cash value and loan. But the death benefit is different. So my recommendation is get a term policy over 20 years, and that fixes that, because if you look at 20 years, you're at 608 and 485 for the investment account versus 400 and 360 with $1 million plus in death benefits. But if you get to 20 to 40 years, things widen up quite a bit more, and you're at a death benefit of 2.3 versus an investment account of 2.6, which this is a death benefit. Your heirs would get this 2.6, so you're actually higher than the whole value in death benefit. And your cash value is $1 million more, because you can loan off of this amount and not this amount. So after 40 years, you're way ahead, and then, if you live to be 90, you're just killing it. And then, of course, if you live even longer than that, it just blows it out of the water. And the main reason for those differences isn't because that whole life is just a terrible vehicle. It's because the interest rate, or the growth rates. So whole life investment is about 4% year-over-year growth rate, where the market itself, I think the average is like 8% year-over-year if you average it over a 20-year period. And so in these numbers, I'm just using a 6% investment rate. I'm just 2 points above what the whole life policy is, and you're doing way better right off. Part two of that is you are not required to pay a premium. So if, year 5, you decide you hit some financial hardships and you can no longer make, I think the premium is about $1,200. You can't make a $1,200 monthly payment into your investment account. Well, guess what? You don't have to. No one's requiring you to. But if you have a whole life policy, you either have to make that premium payment or you have to take it out of the cash value. So it's just not a good vehicle. Where if you do an investment account with a term term on a 30-year-old's life is, $40 at the high for $1 million policy, and then you're growing this in investment account. And so maybe you only funded it for the first 10 years, and you'd still probably beat the whole life policy after that period of time, just because the growth rate is so much better. So I don't completely understand the benefits of a whole life policy. There is no tax benefits to it. The investment account, if your kids inherit that from you, guess what? They get a stepped up basis to fair market value, so it's a tax-free inheritance potentially. If it's over $12 million, want to do something for it. But if it's under that, it's tax-free to the beneficiary of that account. Same with whole life policy. And then there's no tax deductibility of whole life policy premiums. They're not tax deductible, so I don't see why doing infinite banking is better than setting up an investment account and putting any money into it and then taking a loan against its value. So to me, that's the direction to go. But again, I want to point out that I'm not a certified financial advisor. This is not investment advice. This is my observations and my quick math on the whole situation. If you like this video, please like and subscribe. Leave comments down below, and you can check out our information in the description below. Thanks.